The popular image of the stock market is still dominated by screaming floor traders and physical order tickets. In reality, the physical trading pit has been entirely replaced by silent banks of localized servers. Today, the vast majority of trading volume is handled by autonomous algorithms, specifically targeting highly liquid, electronically executable markets. This chart shows the progress in the adoption of algorithmic execution by asset class between 2004 and 2010. Equities quickly pulled away from futures, options, and FX. Equities are the prime target for these systems because of two specific structural conditions. First, there is sufficient volatility for price changes to outpace the transaction fees. Second, the baseline liquidity is high enough to allow algorithms to move in and out of positions instantly. The mechanics of supply and demand are no longer governed by human negotiation, but by quantitative models continuously searching for the optimal mathematical environment to execute a trade. To understand how these models operate, we have to look at market microstructure. Market microstructure is the study of the operational mechanics of how limit and market orders translate into actual trades and transaction prices. Within this theory, liquidity is not a vague attribute. It is a strictly quantifiable mathematical state made up of three components: depth, resilience, and immediacy. Let's look at market depth. This represents the ability of the market to process large volumes of trades without causing the current price to move against you. This chart shows Kyle's lambda, the foundational metric for depth. It measures the sensitivity of an asset's return to the net order flow over a given period of time. Watch what happens to the slope of the regression line. As it steepens, it indicates a higher lambda coefficient. This means the market is highly sensitive and less liquid. Drop a large block trade in here, and you will suffer severe price slippage. The second critical dimension of liquidity is immediacy, which is measured by the Amyhood illiquidity equation. This chart shows the Amyhood formula, which calculates the explicit cost of immediate execution. It does this by comparing the daily absolute stock return against its daily dollar volume. Algorithmic trading systems operate perfectly within these mathematical bounds, but they rely on the strict assumption that the market will behave according to historical patterns, which leaves them totally exposed to unpredictable, exogenous events. These mathematical liquidity formulas do not exist in a vacuum. They operate inside a rigid electronic architecture where orders are routed. This diagram shows market participant connectivity. Notice the central broker-dealer nodes and their direct pathways to the exchange and ECN. Look at these low-latency pathways at the bottom. Computer-mediated orders bypass retail channels entirely, flowing directly from institutions into exchange matching engines. But we must separate the routing infrastructure from the actors. The ECNs are just the roads. The actual trades are generated by autonomous algorithmic engines. Inside this rigid network, these algorithms do not share a single objective. They are divided into distinct species based entirely on how they extract value from market liquidity. The baseline species in this ecosystem is the electronic liquidity provider, or ELP. ELPs are uninformed actors. They quote bid-ask spreads across thousands of securities purely to capture the margin of the spread. They act as the primary source of the very liquidity that Amyhood and Kyle quantify. Contrast them with statistical arbitrage algorithms. These are informed models that hunt for historical price relationships, like pairs trading, to actively exploit any mathematical deviations. Next is algorithmic execution, which is the mechanical process of breaking massive parent orders into thousands of invisible child orders to minimize market impact over time. And finally, predatory trading. These algorithms utilize a rapid place and cancel mechanic to sniff out and exploit the hidden positions of large institutional players. But all of these complex mathematical models share a single core vulnerability. They rely almost entirely on endogenous market data. They only look at price, volume, and order book depth. Take a statistical arbitrage pairs trade. If the price of one asset diverges due to a real-world cause, like a sudden CEO resignation, the algorithm doesn't know that. It will blindly execute the wrong trade, falsely assuming the price will revert to its historical mean. To survive sudden, massive structural breaks in the data, the fastest algorithms in the world cannot rely solely on price. they must be engineered to read and react to exogenous human news. This requirement introduces a concept called intelligence amplification, or IA. IA deploys machine learning to automate the human cognitive process of reading and contextualizing financial news. Every day, the market is hit with an overwhelming asynchronous barrage of unstructured text from newswires, SEC filings, and corporate press releases. The first step of the news analytics pipeline solves this formatting problem. Natural language processing algorithms ingest this raw, qualitative text and begin elementizing it. This starts with entity recognition. The system scans the text for company names and assigns permanent point-in-time identifiers, like tickers or ISINs, to eliminate ambiguity. ISIN stands for International Securities Identification Number. Next, the algorithm generates a relevance score from 0 to 100, filtering out passing mentions and flagging only stories where the target company is the primary contextual subject. This critical pre-analysis phase successfully transforms chaotic human language into clean, machine-readable XML metadata, prepping it for mathematical scoring. XML stands for Extensible Markup Language, a format used to store and transport data in a structure that both humans and machines can easily process. Now, the system faces the core quantitative challenge. How does a machine determine if a deeply contextual news story is actually good or bad for an asset's price? It uses the Event Sentiment Score, or ESS. This is a granular index ranging from 0 to 100, derived from training sets classified entirely by human financial experts. This graphic shows the ESS scale in action. Values above 50 indicate a short-term positive price impact, while values below 50 indicate negative sentiment, giving the algorithm its immediate directional bias. But the most critical metric for algorithmic latency is the Event Novelty Score, or ENS, which calculates exactly how new the information is. The ENS operates on a strict 24-hour decay window. The very first breaking headline scores a 100. Subsequent derivative stories on that same event score progressively lower, preventing the algorithm from executing duplicate trades on old information. The ESS provides trade direction, while an ENS of 100 provides the immediate trigger. And this allows informed algorithms to act on exogenous data before human traders even finish reading the headline. Let's synthesize this entire system. What happens when we inject a high ENS, negative ESS news event directly into the fragile liquidity environment we mapped out earlier? The reaction is immediate. The uninformed electronic liquidity providers detect the extreme sentiment shift. To avoid adverse selection, they instantly widen bid-ask spreads or withdraw from the order book entirely. This is the Kyle's lambda scatter plot again. As those liquidity providers withdraw, market depth mathematically collapses, meaning any subsequent order will cause severe price slippage. Simultaneously, the informed statistical arbitrage models ingest the updated ESS. They cancel their standard historical reversion strategies and execute aggressive unidirectional trades directly into that evaporating liquidity. High-frequency trading and algorithmic news analytics have fused the raw processing speed of the machine with the unpredictable volatility of human events. In modern quantitative finance, the qualitative world is no longer an external factor. It is just another normalized data stream, mathematically driving the microstructure of global liquidity.